Hello everyone, welcome to a free YouTube educational webinar. We're going to be talking about the topic reducing losses. So I had a few people when I put it on the Instagram that they wanted to focus on reducing their losses. So I thought today I would do a free educational webinar for everyone in the YouTube there who's been supporting since day one, or those who maybe have recently joined, and this is something that applies to you. It's going to be a really good watch. We're going to be focusing really on, some of the things that kind of determine when to reduce your losses, the real reason of why it's so important. But really cover this concept in great detail. I mean, in terms of this as a webinar, this is probably one of the most important webinars that you could ever have. I mean, if you really think about it, a trader that can reduce his losses and maximize his wins, I mean, that's obviously the goal for everybody, right? But to do that, you have to understand why you want to do that, and you have to understand the things that make us as traders, want to reduce losses. Some people are going to argue, okay, well, how do you know there's going to be a losing trade to reduce the loss, right? Because it's all well and good saying, oh, cut losses, but the whole point of the trade is you don't know whether it's going to win or if it's going to lose. So how do you know that that trade is going to be a loss, right? Because if you're sticking to a strategy, technically, right, I know some people are going to say, well, if you have a strategy and you trade the head and shoulders pattern, how are you going to know if it's going to be a losing trade or etc., right? Obviously different strategies will be different into how you're going to reduce your losses. So I think what we're going to do obviously is how me being a scalper, I like to be in and out within the next candle. So what I like to do is I like to predict where the next candle is going to go. So that gives me a lot of margin to say, okay, well, if I'm wrong, how can I be wrong? Well, if I'm anticipating price to continue in the direction that I've taken the trade. So if I'm looking for sells, I'm expecting the next candle to go bearish. So that makes it pretty simple, really, is how do I reduce my losses? Well, I'm expecting price to continue bearish, right? So if you think about that on the flip side, well, what happens when a candle goes bullish? Well, that means I'm wrong, right? Am I wrong? Am I not? We'll see. We're going to look at we're going to go into a few examples. I'm going to do some illustrated drawings because these are kind of things that I've seen, I can kind of visualize in my head. And these are real life examples of things that have actually happened and how I learned from the mistake so I could reduce my losses. Okay. So anyway, if you know me, if you know from the live streams, you're going to know that one of the reasons why this year 2020 was a really good year for me was because when I first started, when I first became profitable, I soon realized that for me to maximize that profit, I really need to look at the losing trades. So what I did was, for many months, is I didn't care about if a trade won. If the trade won, that's great, right? If the trade won, that's fantastic, right? But if the trade was lost, if the trade lost, I would be looking at that loss. Okay, how could I have either avoided that loss? How could I have reduced that loss, right? Or how maybe I could have, closed the trade early because there was clearly some signal to say that my idea, my plan was wrong. Okay, so we're going to dive into that today. I really do recommend everybody watching the full webinar because, I feel like there's going to be a lot of value in this webinar. I mean, if you can't reduce your losses, then your losses are always going to be the same. Let's put it in that perspective. Your wins are going to be different because, sometimes price is going to move 8 pips into profit. You might secure at 8 pips and then, ends up being a losing trade. Sometimes it's going to push 20 pips into profit. Sometimes it's going to push 10 pips into profit. Sometimes you're going to catch a nice big 80 pip move. But when you have a stop loss and you know how much you're losing originally, and if you don't do anything about your losses, you know exactly every time how much you're going to lose because you already knew how much you were going to lose because you placed the stop loss. Well, I hope people place the stop loss, but you know how much you're going to lose. When it comes to wins, some people are going to have a good winning strategy. So they're going to say, I'm going to secure at 20 pips every time. I'm going to close 80% at this price. I'm going to close this at this, right? Other people say, okay, well, I'm going to try and let the trade run. I'm going to trail it behind each candle. I'm going to secure positions at my visual target area. That's where I'm going to secure, right? So there's all these different ways of doing things. So you have to mold it to the way that you trade is going to be the most important. So anyway, let's get started here. Let's dive straight in to the first PowerPoint. So one of the biggest problems that traders have is knowing when to close a trade early or when to recognize that the conditions for that trade have changed. So what I mean is, obviously, knowing when to close a trade early is really, really important, because sometimes, for example, if we're taking a sell and price is breaking out to the downside, so we're looking for more downside. So if you can just visualize, you got a support right there and price is breaking support. So we know when we get our breakout, when we have a breakout, we know that, there's a higher probability that price is going to break out in that direction. That's why we call it a breakout, because we have consolidation, price breaks out of the consolidation, and we expect price to continue. Now, sometimes what's going to happen, which we see happen a lot on the live streams, is where price closes back in the range. So we know that's what's called a fake out. We know that price gave us the confirmation that it was going to break to the downside, but then actually it closed back in the range, and actually it gave us the confirmation that it was a false breakout. Now, when price has done a false breakout, this is a signal to close that trade early, because now actually the probabilities are in favor that we go in the other direction, because we failed to sustain that move down. Okay, so these are some of the things we're going to be talking about. And obviously, when we're talking about recognizing the conditions for the trade has changed, well, the condition is, let's say, just as a short example here, let's say that this is our support right over here, and let's say the candles are closing below, and we're like, okay, well, we took our sell, I don't know, somewhere over here. This is our entry, this thin line. Now, our conditions for the trade is that price has to stay below this support, this red zone. It has to stay below in order for price to continue down, because if candles are closing back above that area, this would be the false breakout. So our condition is price staying below. Now, what happens when you get a candle that comes up and closes back in the range? Well, there's a condition to say that, okay, the condition for my trade has changed because price has closed back in the range. So maybe my sells are not viable anymore, right? So that leads me on to my next point. Leaving a trade to hit stop loss will not give you an opportunity to cut back losing trades and reduce the loss of the trade. So if you see a false breakout happening and you was in the breakout trade and you're just saying, okay, well, it's come back in the range, but it still could, then you're leaving price to hit your stop loss, because now you have no control. You haven't managed risk. You haven't cut the trade short. You haven't closed positions. You're going to let to see if price will hit your stop loss. So you're not giving yourself any opportunity there to reduce your risk. Let's say your risk was £100. You could have quite easily got that risk or that loss down to £50, £60 had you have closed positions at that point. Now, when we execute a trade, we expect price to continue in the given direction. So if we're in buys, we're expecting the next candle to go bullish. If we're in sells, we're expecting the next candle to go bearish. In the same way, right, in this closest kind of analogy that I can think, in the same way that we plan journeys based off traffic and the quickest route. So what I mean by that is we take buys because we expect price to continue in that direction and we've had confirmations. When we're planning a journey, right, we're looking at the quickest route with the least traffic. So when we have planned, right, and we say, okay, well, we know it's going to be a 10-minute drive, there's clear traffic, I know the quickest route is down the back roads, right? So we plan that journey and we're saying, okay, we know that we've got to be somewhere at 10:30. It's 10 o'clock now. It's going to take me 10 minutes. So I'll probably leave in about 10 to 15 minutes to allow myself a little bit of leeway. But we planned, and that's how it is, right? So we planned to go in that position. To make that journey the same way we planned to take a trade. Okay, and when we plan to take a trade, we're expecting price to head to 138, 139. The same way when we execute on our journey, right, we're expecting there to be no traffic because we checked the local traffic news. We know the quickest routes, so that's why we make those decisions. Right now, what happens, let's say, when we leave to get from A to B, and we're saying we expect to arrive at the destination for the planned time? What happens if we hear of a collision or a road closure on our journey? Do we just sit there and wait? Because obviously we had somewhere to be at 10:30. Do we just sit there and wait? Obviously, I know that's the right thing, the patience, not being so eager to change route. But think about it from a different perspective for a minute. Not from a selfishness perspective, not from the perspective that, oh, well, you could have just waited and got there a little bit later. But what we're saying is, along the journey that we planned, something happened. Something happened along that journey. There was a collision, there was a road closure. So what do? If there's a road closure and you planned to go down that road and there's a road closure and you didn't know, what are you going to do? Right? The same way, if you're in a trade and you're taking sells, but price is going against you, what are you going to do? Okay, do you let stop loss get hit? Do you stop? Do you not continue with your journey because the road is closed? What can you do? Right? We have to adapt. So we adapt from this information and we alter the route, we alter the trade. Okay, so in the same way, a good trader will recognize changes after placing a trade which may affect how the trader anticipated price to go. Okay, so when we're talking about the journey example, we're saying, okay, well, we plan to go from A to B. There was a road closure on our way, so now I have to make the decision to maybe try a different route, go down a different road, or reroute myself, basically. So there has to be some form of adaptation to the plan. That is the key here. You plan one thing, something happens, and you have to adapt on the spot. So obviously, I'm a big believer in, you have to be prepared. So a lot of the success is done in the preparation, but where the true success lies and where a true skilled person can shine is when you're put under pressure, when you're put under a challenge. So we can plan for every single possibility, but then if something happens and you're not quite sure how to deal with it at the time, you're going to panic, you're going to make bad decisions. So we need to be focused and we need to be clear-headed so that when things happen, we can make an informed and rational decision. So we also have to be prepared, and we also have to be prepared to adapt, right? So it's not just about prepared for the trade. This is where I'll exit half. This is where I'll close 80%. That's fine. But what happens when something else happens that we didn't plan for? So we have to be able to adapt, right? So just going to move on here. So keeping losses small will be the key to many traders' success. I know a lot of you are having this break-even stage. You're having losing streaks, right? You're having low win rate weeks, like 30%, 40% win rate, and you're like, man, I just don't know. So keeping your losses small is going to really help to either, it's not even about increase the win rate, but it's increase your profitability, right? It's going to help with your psychology, because now let's say you've taken 2 losses, but both losses hit stop loss. You're down 20 pips, let's say, because you had 2 10-pip stop losses. You're down 20 pips. If you cut those losses short of 5 pips, 4 pips, now you're only down to 1 loss, 1 full loss. That's all it is. So now your psychology is, I've taken 2 trades, I've taken 2 losses, but actually I've only lost 1 trade, because that would have been what I would have lost. So that gives me an opportunity that if I've taken 2 losses, now my probabilities for the week suggest that I should have wins from this point. So now I need to focus on, again, keeping that strict risk management. So now onto the question. So how do we keep losses small? So this is where I'm going to run into a few examples examples of, you know, when to know when maybe the trade is not viable, how to or when to close positions, how to manage risk. We're going to get into that now. So how to keep losses small. I think the best thing to think about is focus on the idea of probability. So let's work through an example here while we go through this. So let's imagine we have support down over here. So this is a support area. We know this is a support. And why do we know this is a support? Because we have a candle closing bullish. And let's just say 6 months ago, this was a really strong area and we had candles, you know, closing at this area. So you can visually see when we look left on the chart, this is a strong zone. Now, you've taken buys at this point because you see a candle closing bullish and you're like, okay, we're at a strong support. We see multiple rejections here the last time, and you're really expecting the next candle to continue up. Let's also say that price was in an uptrend for, you know, specific examples. So let's just say it was in an uptrend and that price was closing back above a key support. And then you waited because you did the right thing. You waited for candle to close and you waited for a bullish candle to close in your direction above a strong support level. Okay, so we've got all that visualized now. So let's just say, for example's sake, that you have a rough 80% chance of this trade working out. Why? Because you have a candle closing bullish. Let's say you waited for the 30-minute time frame. So it's a strong confirmation time frame. So the probabilities are higher. Let's say both 15-minute candles were healthy 15-minute candles. So we're confident. We have 80% chance of this trade working out. We use 1% risk, right? We use 1% risk. Let's say the 1% risk is £100, dollars, whatever. So let's say you're trading a one lot position because the stop loss is 10 pips. So let's just, for visual representation, we're going to use this as our stop loss. So the stop loss is down over here. Let's say the entry was taken on the close of the candle because we're good. And let's just say our TP is up over at this resistance right over here. So our target's around, let's say 25 pips. The risk is around 10 pips. We have enough range. We've got good confirmation. We have a good stop loss position. I've used 1% risk and it's a one lot position. So we have an 80% chance. 80% chance is working out. Now, let's say we're focusing in on the 30-minute. We're not worried about the 15-minute because we're just anticipating the next 30-minute candle to continue in our direction. That's what we're anticipating. Now, obviously, it says here, since then, X happened and reduced the probabilities to 50% chance. What's going to be that X happen? Well, let's say we're on the 30-minute time frame, and then what's going to happen, because we was expecting the next candle to go bullish, right? So what's going to happen is the next candle, it continued up, it pushed into profits around 5-6 pips. Everyone was happy. You know, we were happy because it's anticipating going in a direction, and then boom, we have a candle closing bearish like this, right? So now what happens? Well, let's run through this. So the entry was taken over here. We pushed around 6 to 7 pips into profits. Let's just say 6 to 7 pips into profit. There's multiple things we can do here. Now, it depends on your level of risk, depends on your level of tolerance, but let's say price pushed 6 to 7 pips into profit. I know some people, and I know that sometimes I'm going to do this, is I'm going to say, okay, well, if price pushes 6-7 pips into profit, but then pulls back to my entry, this is the point at which I'm going to close 50%. So let me just really make this obvious. This was the entry point. So this was the entry point, stop loss, TP. So the candle came 6-7 pips into profit and then it retraced. So let's say you're a trader that closed 50% when price came back to your entry. So now let's do that. So trader one is going to close 50% as price came back to his entry. So he's closed 50%. Right. So this means if he had a total risk of £100 with a one lot position open, he now has £50 left to lose on this trade because he's closed positions when we come back to his entry. which equals to what, 0.5% of his account is now risking, right? And he's only got, 0.5, right? So that's fine. So that's trader 1. Trader 2, let's do in a light blue over here. Trader 2, now he's going to say, okay, Trader 2 is going to say, okay, well, price moves 6-7 pips into profit. That's fine. Didn't want to do anything yet because, we have to let the trade play out. Now, Trader 2 is going to say, okay, my decision is going to be, well, the candle's still respecting the low of the previous candle. So, I mean, my trade's still valid, right? It hasn't broken this support. It's still closing above this area. Okay. I'm still going to expect price to continue bullish. So Trader 2 does nothing at this point, right? Then we're going to have Trader 3. Trader 3, he's different. Trader 3, he's a very, very risk. He's a trader who likes to be a bit more, I think the term is like risk averse, right? So he's going to look for any excuse to reduce the risk. So not only did he close 50% when price pulled back to his entry, okay, which means that his risk was also 0.5. He also closed another 50% in a -2 pip drawdown when the other candle closed bearish. So he closed 50% and then he closed another 50%, right, when the candle closed against him. So his first 50% was closed at break even, which means he had 50% left on the table, which is £50. He closed another 50% in a -2 pip drawdown, which is like what, £10. So now he's taken a -£10 hit, but the overall risk is 40, right? Maths might not be dead on, but his risk is £40. That's all his risk is. I'm pretty sure, right? But you get the idea. So now his risk here is a lot less because he's saying, okay, well, this happened. This is the first position. This is the first thing that happened for me to reduce risk. And then the other 50% was the second thing that I did to reduce risk. So there's Trader 3. He now has got the lowest amount of risk. He's only got £40 left from £100 that was the original risk. Trader 1 has got just a £50 risk left on the table. But Trader 2, he has the full 100, right? He has the full 100 still left on the table, okay? Now, let's talk about what happens next, right? What happens next? So the first candle, obviously, we know closed bearish. So the point of that is it makes the overall probability for the next candle to go bullish a lot lower, because the first time the candle closed bullish, we had an 80% chance of the next candle going bullish. Now we have a less than that. Let's just say roughly 50%. I would go probably maybe 40% because, they kind of close bearish. So higher probability for the next one to go bearish. But let's go 50%. So now what happens on the next example? Next candle comes down, also closes bearish, right? Next candle comes down, also closes bearish. So now let's go again through what the traders do. So Trader 1, he'd already closed 50%. The next candle closes bearish. And what he did was he said, okay, well, since the next candle closing bearish, I'm going to close another 50% because, it hasn't quite broken the low over here. It's still closing above that area. It's closing against me. So I'm going to close another 50%. So now he's closing 50% of his position. He's in a -5 pip. Let's say actually he's in a -8 pip drawdown right over here. So this is where he's closing out his position. Right, so 8 pips is going to be around, let's just say £30, right? So he's closing this half in a £30 loss, right? And now he's leaving the rest of the position to hit stop loss because now he's saying, okay, well, that's fine. So roughly speaking, he's probably going to lose maybe £40. Let's just say, for example, £40. So now trader number 1, he is coming out with a total loss of -40. That is his total loss of this trade, because, you know, it's more than likely at this point going to hit his stop. Okay, so we've identified there that trader number one is coming out of this trade with a -40 loss. So it was much better than he anticipated, but could it have been better? Potentially. Now let's look at trader two. Now trader two, he's a bit unsure what to do at this point, because obviously he understands that, okay, well, it's not broken this support, it's not broken the low of his breakout candle or his candle that he took the buy, or she took the buy on, but he's still thinking, you know, it's still closing above that area. So what's the point of, so he's still in it. Here's a risk is £100 still. And let's just say, for example, in this particular example, it's going to hit full stop loss. So he will lose 100. He's going to lose £100 for trader number two. But trader number three, now trader number three was on it, because trader number three recognized that if we break this low of the previous candle right over here, it's going to decrease his probabilities of winning even more. So he closed his full position once price hit or broke that low right over there. So we knew that he had a maximum risk of £40 left, but we know that he had still that £40 left on the table. Now let's say this break of this low was roughly around 4 pips, minus 4 pips, sorry, in drawdown when he closed the rest of the position. So this is going to mean that trader number three has got out with his trade, let's say with an £18 loss. Okay, trader number three is going to go out of this trade with an £18 loss, because he exited his position right over here, because he recognizes that if the candle is making lower high and lower low, that it is going to reduce his probability by a lot. So he recognized that, and he got out of this trade with -18. Okay, so there you have three different kind of types of traders there, and how three different traders would, you know, react to this situation. So let's talk about maybe how this could have been different, or, you know, how we can mold this to, you know, a different trader. Now, the first rule that I'm going to say is how can we identify, you know, what made price or the probabilities reduce. So the first is candle closing against. So that's the first thing that's going to be doing, candle closing against. Okay, hard drawing, but candle closing let's just put against, right? So candle closing against is our first. Okay, now let's say you're in buys. Trader number three, he recognized that if we break this low over here, the probabilities are going to be less. So if we're in buys, we're expecting the low to be respected. Just put respect. Okay, we'll just put respected. So respected that low to, we're expecting that low to get respected. The same way we was respecting our low of the candle that we took the buy on, or the trader took the buy on, to also be respected, because that was a place of stop loss. So that's the first, the third thing. We're also talking about when price goes into profits. How are you going to react when price goes into profits? You had cash there, you had money there that was going to be your profit, and then it came back into a drawdown. How are you going to deal with that? You also have when price is just sitting in a drawdown. Just going to put DD. So what's going to happen is sometimes when we take this buy over here, this candle, it may not push into profits. It may just start running down into drawdown. How are you going to deal with that? Okay, so these are all the things that you need to think about when it comes to cutting your losses. But I would just say this is a good example of different perspectives of the same entry, same style of trading. Now, on a different example, this is where you have to think, what type of trader do you want to be? Because in a different example, trader one and trader three, they're going to come out with losses, because, you know, sometimes candles are going to close against them. So in this particular example, obviously we know that trader two, he came out with a full loss. But sometimes there's going to be an example where, let's say, the next candle is going to go bearish, maybe close like weak like this, You know, this is something that's happened to me. And then the next one's going to break the low. So trader number three, he's definitely going to be closing out his positions, right? He's definitely going to be closing out his positions because he had a candle close against. He had the next candle come down and break the low. So we see that breaking the low, but then it continues in our direction. It continues on our direction. So trader number two, he's going to have taken a win because he never reduced his risk. Trader number one, he would have closed 50%. So he's now let the other 50% run into profit. So he's had a small profitable day. Trader number two, he's had a good day. But trade number three, he's closed everything. His trade was a loss. So now you have to think, okay, well, this is where back testing comes in. This is where comfortability comes in. So you have to think about what's comfortable for you. You have to think about what have you seen before. You have to think about your type of entry style, what works best, what increases your probabilities. But I think this is going to give you a good perspective on the different ways that you can reduce risk or can cut your losses short. So sometimes trader number three, he's going to be laughing because he's going to have got out with a trade with a really small loss. And trader number one, some days he's going to be laughing because, he's closed certain positions and let the rest to run. Some days trader number two, he's going to be pretty pissed off because he's just had a full position hit stop loss. But then other days he's going to be really happy because he let the full position swing and he let the full position run into profits, right? But no matter what way you choose or no matter where you go, you need to remember one simple thing is that we cannot predict where price is going to go. No one can predict where price is going to go. Even me, HFX, I cannot tell you where price is going to go. I can only tell you where I think price is going to go. I can only predict where I think price is going to go. But I don't know for sure. I'm going to never put my mortgage on it. I'm never going to put my life on it because it's not given. It's not certain. So what is certain, what is given is how you manage your risk. So with that in mind, I want you to go away. I want you to think about the ways that you feel most comfortable about reducing your risk and the ways that you feel most comfortable in reducing your losses. Remember, each person is different and it doesn't need to be that you reduce every single possible way that you can. It doesn't need to be like that, but you need to be thinking about how you can reduce your losses. Even if you want to be a trader number one, even if you want to be a trader number three, but even if you want to be the trader number two, even trader number two needs to understand that he could have a better profitable outcome if he looked at the ways in which he could reduce his losses. Okay, so you have to remember these things, guys. But anyway, I want to say thank you to everyone for watching this video. I really hope this helped people out there who may be unsure or stuck on how they can really reduce their losses. Remember, think about it in terms of probability. What's going to reduce the probability of your trade working out? Or what's going to increase the probability of your trade not working out? Okay, so all of these things you have to remember. If you're a swing trader, it's the same kind of concept. What are you looking for on smaller time frames to see if your trade isn't playing out? Okay, this is obviously more for scalpers or people who potentially trade very similar to me. But you can adapt these things to the way that you trade because you're going to see if things that are going to happen, right? So it all depends. It all depends. But there you go. So thanks everyone for watching this video. I hope it helped. Make sure you're subscribed to the YouTube channel. Make sure you drop a like. And yeah, we'll see you for the next webinar that will be posted in a few weeks' time. Thank you very much.